Okay. Hmm.
Hi,
Hi, how are you?
I'm doing great. Thank you. I was sending an email to Melinda because I was trying to get in and it said that the host was in and I had to wait. So I was worried that maybe something was off.
So sorry.
No, that's
Um,
okay. So sorry. I panicked because I thought like, do I have the wrong link?
oh man, I was just sending you an email and then I was like, wait a second, let me check the participants.
Yeah,
So
yeah.
you're
I
here.
was there.
Okay.
Yeah. Good.
Okay. So sorry about that. I mean,
No, that's okay. I was panicking because I like to be on time and I was like, "Oh my God, the session's going to start and I'm not in."
yeah. All right. So now that you're here, we are going to do it how I normally do. I'm going to start in English. Welcome everybody. And then I'm going to go through the slides. Do you already have a copy?
Yes, I do.
Okay. Okay. At the end, I do have some other slides that I can send you. I don't know if maybe I should just send these to you right now so you have them, but I know,
Um, I mean, if you're going to be presenting the bilingual version, I think we're good anyway. So,
yeah, that's true. Yeah, it is bilingual. So, okay. So I'll let people in here in just a second. I'll put all my notifications on pause because you can hear that, right?
yeah.
Okay. Um, all right. How long do they have us doing this for? You have an hour, right?
Yes, I was told I have an hour. I mean, if it needs to run longer, it can run longer. It's okay.
Okay. We'll
But
go
yeah,
ahead.
I have it marked for an hour.
Perfect. Yep, that's all. All right, I'm going to admit everyone now.
Okay.
Hello, everyone. Give me a thumbs up if you can hear me.
Hola a todos, les pido por favor que marquen la expresión de deditos para arriba si nos pueden escuchar.
We still have a few people joining. Hi, thank you, Natasha. Appreciate that. Awesome. All right. So I'm gonna go ahead and get started here. I'm gonna welcome everybody in, and we're gonna have a Spanish translation or interpretation on in just a minute. So I want to give providers about one more minute to get in. This is understanding business debt. So we'll get started here in just another minute.
Bueno, estamos por comenzar. En un momentito vamos a iniciar el sistema de interpretación, pero simplemente les voy a dar un minuto para que todos terminen de conectarse a esta charla de Entendiendo la Deuda Empresarial. Vamos a empezar en un minutito.
All right. Good evening, everyone. My name is Rob, and I'm from Civitas Strategies. I also have Sol here, and she's our interpreter. We're going to go ahead and go through the instructions on how to get into the interpretation room, so that way you are hearing only the language that you choose to listen to. And this is Understanding Business Debt, sponsored by the DECAL Thriving Childcare Business Academy.
Hola, buenas. Yo soy Rob Tacklin. Estoy aquí con CBT Strategies. Conmigo está Sol, la intérprete de español. En unos momentos vamos a darles las instrucciones para que puedan ingresar correctamente al canal de español para que escuchen esta sesión en español. Y estamos aquí en una sesión de Entendiendo la Deuda Empresarial con patrocinio de DECAL Thriving Childcare Business Academy.
So, okay, so here we have the language rooms. Once I turn them on and they're open, you'll see a little button appear for those of you that are on your desktop computer or laptop. The little interpretation button will come on, and then you'll see also be sure that you choose either English or Spanish in order for you to hear the audio for tonight's presentation. If you are joining us on the mobile device, whether it's a tablet or an iPhone or Android, you'll go ahead and select More and then Language Interpretation, and then you'll be able to see the language options that are available. I haven't turned them on yet, so you don't see that just now, but once I do, they'll come on, and you can follow the on-screen instructions here. Okay. And now Sol will be explaining what I just explained in Spanish.
Hola, buenas noches a todos. En este momento estamos a punto de iniciar el sistema de interpretación. Si ustedes están ingresando a la sesión por computadora, les vamos a pedir que la activen haciendo clic en el icono del globo terráqueo, ¿sí? En ese caso van a elegir el canal de español y silenciar el audio original. Next slide, please. Si por el contrario están ingresando a través de un dispositivo móvil o un teléfono, les vamos a pedir que hagan clic en más y elijan interpretación de idiomas. En ese caso, simplemente van a tener que elegir también allí la opción de español y silenciar el audio original. Gracias. Rob, we're good to go.
Great, thanks so much.
No, you're welcome.
Just a second, and turn these on. Mhm. Okay, so just 1 second.
Un segundito más, por favor.
While I am getting this part adjusted here, please go ahead and
Mientras,
add your name and the PDS number in the chat.
mientras que voy preparando el sistema de interpretación, les voy a pedir por favor que pongan su nombre completo y su número de PDS en el chat.
Also, please send me a message privately if you absolutely need the Spanish translation.
Asimismo, me gustaría pedirles que por favor me envíen un mensaje por privado si necesitan la interpretación al español. Gracias.
Okay.
Hi, Rob.
Hi, Jen.
Hey, so could you just make me, if I'm not already a co-host, can you make me a co-host?
Yes, I sure can.
I appreciate it. And everyone, thank you so much. This is not, I do not want this to be a reflection on Rob. Sometimes technical stuff happens. So, all right. Okay, so hang on just a second, Rob. Rob, do you see the interpretation channel? It's on.
It is now on.
Okay. Do you just
There
want
it
to
is.
see? Okay,
There we
great.
go.
Saul is in?
Yes. So,
No one? Then
okay.
no one needs me.
Nope, you're good. Thanks, Jen. I
Have a great
appreciate
presentation,
you.
everybody. Enjoy. Thanks. Bye.
Thanks. So go ahead and click the interpretation button and get into your specified language channel, and we'll get started.
Excuse me.
Yes.
It looks, I think I'm on here logged in 2 times. I'm not
Okay.
able to put anything in the chat. I'm in S more, and I think my daycare is also on here. I'm
Sure.
not even
I
able
can
to put
remove.
anything in the chat. I don't know.
That's okay. That's okay. I'll remove S more if that's all right.
Yes.
There you go. Great. Now that everyone should be in the correct channel, thank you all again for your patience. Again, my name is Rob. I am excited to guide you through this crucial aspect of managing your business's financial health. And I want to help you identify how business debt works, learn to evaluate the different financing options, and develop strategies to help you make informed borrowing decisions that support your company's growth while still maintaining financial stability. A quick disclaimer, the information contained here has been prepared by Civitas Strategies and is not intended to constitute legal, tax, or financial advice. The Civitas Strategies team has used reasonable efforts in collecting, preparing, and providing this information, but does not guarantee its accuracy, completeness, adequacy, or currency. The publication and distribution of this information is not intended to create, and receipt does not constitute an attorney-client or any other advisory relationship. Reproduction of this information and recording of this content, including the use of AI, are expressly prohibited, and only non-commercial uses of this work are permitted. Today, we'll cover these crucial topics. One, we'll dive deep into understanding the true cost of debt beyond just what you borrow, and this includes interest rates, repayment duration, and potential consequences. We'll also guide you through the process of assessing your debt to asset ratio. It's a key indicator for your business's financial health. And we'll also walk you through creating an effective debt repayment plan tailored to your business's specific needs and capabilities. We will also be discussing how to recognize warning signs that your debt might be becoming unmanageable and help you catch potential issues early. And finally, we'll explore various professional debt management options available if you need additional support. By the end of this webinar, you'll have a comprehensive understanding of how to manage debt effectively in your childcare business. So, what's the big deal about debt? Whether it's for personal or business reasons, nearly everyone encounters debt at some point in adulthood. Because it's so commonplace, it can be easy to focus more on its advantages, sometimes overlooking the potential risks of borrowing money. While debt can be a tool that supports resiliency, sustainability, and growth when used properly, there are two notable issues that are important to recognize. First, when you borrow money, you will usually have to pay interest, which means you'll ultimately be paying more than the total amount you owe. Even if this is a worthwhile investment, if you don't really know the terms of your agreement or don't have a good plan for paying back what you've borrowed, you could end up losing a lot more money than you realize, or worse yet, finding yourself in a cycle of debt that is difficult to escape. Second, depending on your current circumstances and the type of debt you're taking on, borrowing money may come with great risk. Committing to debt repayment can strain your finances, especially if you're already on a tight budget. High monthly payments can limit your ability to save, invest, or cover unexpected expenses, leading to increased stress and financial instability. In addition, some types of debt, like mortgages and home equity lines of credit, or HELOCs, are secured by your property. If you're unable to make payments as agreed, you risk foreclosure and losing your home. Debt can be a great tool that assists in accomplishing many things. But like any tool, if it's not used properly, it can cause problems for your business. Before taking on debt, it is important to consider the benefits, the true cost of borrowing, and your ability to repay the amount borrowed. Before you do anything, it's important to make sure there's a clear benefit. To get started, ask yourself the following two questions. What is the purpose of the debt? Clearly define why you need the debt. Is it for expansion, purchasing new equipment, managing cash flow, or another specific purpose? Understanding the purpose will help determine if the debt is justifiable. How will the debt improve the business? Assess how the borrowed funds will impact your business. It will increase. Will it increase revenue? Will it improve efficiency? Or is it going to provide other significant benefits? As you answer these questions, think about how the impacts will help you in the long term. For example, debt might be a good choice if it will help you with expansion and growth. Debt can provide the necessary capital you need to expand your childcare facility, whether it's opening new locations, renovating existing ones, or investing in additional resources and equipment. Two, you could be investing in quality. Borrowing money can enable you to invest in quality improvements for your childcare business, such as hiring qualified staff or enhancing educational programs, maybe upgrading facilities or obtaining certifications and accreditations. And three, financial relief or resilience. Debt can also provide financial relief by offering a safety net to cover unexpected expenses or navigate through periods of lower profit margins. The key is that the responsibility of the debt repayment, the experience of keeping up with them, and the money lost to interest are outweighed by the benefits of what you're buying. So, for example, A loan to renovate a room in your childcare facility that will allow you to take on additional children might provide you with enough revenue to quickly repay the money you've borrowed and also lead to a permanent increase in revenue. This is also considered your return on investment, right? Understanding the real cost of borrowing goes beyond just looking at the amount that you borrow. You'll also need to consider the interest rate, the duration of repayment, the consequences of not being able to pay back what you borrowed as expected, and the money lost versus the money saved. Now let's take a closer look at each of these considerations. One thing I'd like you to also do is, if you're taking notes, go ahead and create a space in your notebook and label it parking lot. If there are any ideas, any thoughts, any questions that you might have, I want you to write them down, because there's a lot of information that we'll be going through. And at the end, you'll have time for questions and answers. And also, it might also bring up something that you want to bring into a one-on-one coaching session. Okay. Now, understanding the real cost of borrowing goes really beyond just looking around the amount that you borrow. You'll also need to consider the interest rate, the duration of the payment, and the consequences of not being able to repay what you borrowed as expected. There are two types of interest. There's simple and compound interest. Simple interest is calculated only on the principal amount of a loan or investment. And you might see simple interest when you take out straightforward loans, such as short-term loans from family or friends, or some auto loans, where interest is calculated only on the initial amount borrowed and not on any additional interest accrued over time. For example, you take out a $1,000 loan from your aunt. She charges you 10% interest monthly. In this case, you would add $100 of interest a month. That's $1,000 times 10%, which is $100. Okay. There's also compound interest. This occurs when the interest on a loan or investment is calculated not only on the initial principal amount, but also on the accumulated interest from previous periods. You might see this type of interest on long-term loans, such as when purchasing property or major equipment. Compound interest can add up very quickly. If you take our example of a $1,000 loan at 10% interest, but next month, if nothing is paid, the interest will be calculated off the total of $1,100. So that month's interest is now $110. That is 1,100 times 10%, which gets added to the $1,100 for a total owed of $1,210. Again, if this isn't paid, it is $1,210 times 10%, which equals 121. That amount gets added to that total and will continue every month. Regardless of the type of interest you're dealing with, make sure you understand the total amount you may be expected to repay over time, because it can look very different than the amount you originally borrowed. A second consideration is duration. The duration of repayment may be fixed, as with a traditional loan, or it may extend indefinitely, as with a credit card. Here are some important considerations regarding duration. Longer repayment times often mean lower monthly payments, but can end up costing more overall because of interest. Shorter repayment times might mean higher monthly payments, but could save you money in the long run. Make sure you know how long you have to pay off your debt, but also remember that the longer you take, the more interest you'll have to pay. When considering borrowing money, it's important to recognize potential consequences. If for some reason you end up unable to repay what you owe, late fees, these fees for missed payments can quickly add up. Cutting into your budget, it's crucial to know the amount and frequency of these fees. Collections, this happens if you fall behind on payments. Your account may be sent to collections. This can also lead to persistent calls from debt collectors, which could disrupt your business operations. Credit impact. Late payments can harm your credit score, affecting your ability to secure future financing or favorable terms. Maintaining a good credit score is essential for the financial health of your business. Legal action. If you default on your loan, creditors may take legal action, including filing a lawsuit, wage garnishment, bank levy, placing liens on collateral, or seizing assets to recover the debt. Repossession or foreclosure is another risk. If your loan is secured by collateral such as property or equipment, failure to repay could result in repossession or foreclosure. This could disrupt your business operations and lead to significant financial losses. Now, also something to think about when determining if borrowing is right for you is understanding the opportunity cost. This is the money lost versus the money saved by using borrowing as a tool. Consider this. When you borrow, you're essentially paying interest to another party. However, if you were to invest that same sum in savings for yourself, it could generate returns for you instead. The length of time you spend losing money in interest could instead be significantly impacting your overall savings. Also, rather than increasing risk for your business, you'd be safeguarding your business from unforeseen financial challenges. So while debt can be an impactful financial tool, it's equally important to recognize the opportunity cost of investing in debt versus savings. Take the necessary time to evaluate which financial approach best suits your business needs and objectives. Creating a debt repayment plan. Understanding the costs and benefits of debt is crucial. Now, let's focus on how to create an effective debt repayment plan for your childcare business. Whenever taking on debt, whether you have a choice or not, it's important to think through whether you are going to be able to pay it back easily and what you'll need to do to make sure you're successful in repayment. This will mean you need to understand your minimum monthly payments in comparison to the accumulation of interest, as the longer you wait to pay, the more you may end up paying. For example, say you've taken out a loan of $100,000 with a fixed 5% interest rate, meaning the interest rate will not change during the loan period. You use this to purchase real estate for your childcare business. In this case, if you paid steadily throughout a 30-year term or the length of the loan, you'd have paid a total of approximately $193,000, which is nearly double the original cost of the purchase. It's also important to notice that the interest rate is typically much higher for credit cards, often around 21 to 22%. Imagine that you've made a purchase on a credit card for a play structure that costs $10,000. With these higher interest rates, the $10,000 balance on your credit card could double in less than 4 years, meaning you're paying double on your original purchase. To prevent this from happening to you, start by creating a debt repayment plan that factors in the maximum amount you can afford to pay each month while aiming to minimize interest costs. You can create your debt repayment plan in 5 simple steps. Start by creating a cash flow forecast. Understand your monthly income and expenses. This will help give you a clear picture of your financial situation and help you determine how much you can allocate towards debt repayment. Meaning, if you know how much money is coming in and how much you have extra in profit after your expenses, it'll help you understand how much you can pay towards debt repayment. If you're not making enough to pay the minimum amount or more to repay debt, that may be a factor in whether or not you should or shouldn't take this on. Next, calculate affordability. Based on cash flow, determine how much you can realistically afford to allocate towards debt repayment each month. Then set your repayment goal. Decide on a specific goal for debt repayment, such as paying off a certain amount by a certain date or repaying what you've borrowed within a certain time frame. Make extra payments when possible. Whenever you have additional funds available, consider making extra payments towards your debt. This will help you pay off the debt more quickly and save on interest charges. I want you to remember, when it comes to compound interest, the more you pay up front, the less you pay in interest. Finally, monitor progress. Regularly track your progress towards your debt repayment goal. Adjust your monthly payments as needed based on changes in your financial situation. When you take on business debt, it's a significant decision. But if you prepare for the responsibility, it can be a great tool for your business. By doing so, you can leverage the borrowed funds to drive growth, improve operational efficiency, or anything else that will help you reach your business goals. Now, before we dive into debt reduction strategies, it's important to understand your current debt situation. Let's walk through the steps to assess your debt to asset ratio. Now, while there's no universally applicable threshold for an acceptable debt to asset ratio, a commonly cited benchmark in the childcare industry suggests that exceeding 30% of relative to annual revenue could signal heightened risk. This guideline underscores the importance of aligning debt levels with revenue generating capacity to maintain financial stability and resilience. One effective method for assessing the level of debt relative to a childcare business's financial position is by calculating the debt to asset ratio. This metric provides insight into the proportion of assets financed by debt, serving as a barometer for financial leverage. The formula for computing debt to asset ratio is straightforward. The debt to asset ratio equals total debt divided by total assets. So here's how you can assess your debt. Step 1, gather your financial documents. Collect all your money papers like bank statements, bills, receipts from purchases like toys and supplies, loan papers if you borrowed any money, and any other papers about money related to your childcare business. Some common financial documents to gather are bank statements, bills for utilities, rent or insurance, receipts from purchases for toys, supplies, and other business expenses, loan documents if you borrowed any money, invoices from parents for childcare services, tax records, and lease agreements if you lease your building or equipment. Step 2, make a list of what you own. Think about all the things you own for your childcare business, like the cash in your business checking account, the money parents still owe you for your childcare services, toys, books, and educational materials, their approximate value, furniture like tables, chairs, and cribs, and if you own your building, its value counts as well. So this list is basically a part of your balance sheet. It shows what assets you actually have, and having the name of each asset and an approximate value will help you in this process. Step 3, understanding that value, finding out how much everything is worth, is pretty easy. So cash is worth the amount that you have. The money owed by parents is what they still need to pay. And the estimated value of toys, books, and furniture is based on what you paid for them or what you think they're worth now. So a good example would be a vehicle, right? If you own a vehicle and you're going and picking kids up, the van, if you bought it for $45,000 and maybe it's 5 years old, you can look up on the internet about how much it would be worth, right? So you can go into kellybluebook.com and find out the approximate worth. Step 4, write down what you owe. Think about all the money you must pay back, like bills, loans, or any other money you borrowed. Bills for utilities, rent or insurance, any loans you took out for your business. If you leased your building or equipment, include those payments too. Take a look at your bills, your loan statements, and any other documents to see how much you owe for each item. Another thing to include here would be any money that you would owe to the IRS. If you're paying quarterly or if you have estimated taxes quarterly, I would suggest that you have that as well, right, to figure out about how much you will owe. And if you have any taxes that are late, put that down as well. In the example of the van, if you paid with a loan, this would be one of the things that you would list on there as well. So you'd have for the van, you'd have how much you owe, but also its approximate value in today's dollars. For step 5, see how much your business is worth. Once you add up all the things that you own, these are your assets, the cash, how much parents owe, and the value of your toys and furniture, vehicles, and the like, then subtract all the things you owe, all the liabilities, bills, loans, from the amount that you have, that number that you get is called your equity, which shows how much your childcare business you really own. Okay. Step 6, calculate your debt to asset ratio. To calculate your debt to asset ratio, you divide your total liabilities by your total assets and then multiply by 100. This ratio shows the proportion of your business's assets that are financed by debt. Let's go through a quick example. So if you had $75,000 in total liabilities, divided by $120,000 in your total assets, this equals 0.625. You multiply that by 100, or just move the decimal point twice. 62.5% is your debt to asset ratio. If you remember, one of the rules of thumb was 30%, right? So reducing debt might seem daunting, but with the right plan, you can take control of your finances and work towards a lower or a no debt lifestyle. Next, we'll break down practical steps to help you tackle your debt and start building a brighter financial future. So if you'd like, while I'm speaking, you can create your list of assets. You can give yourself some values and then take a look at the major debts, right? You can also consider, if you run a home childcare business, you can consider looking at your mortgage as one of those debts, right? Your vehicles, any credit cards that you might have. Add all of those up as well, right? Now, how do we create a cash flow surplus? We begin by decreasing costs. Use and maintain a budget. Budgeting helps you plan for what you will spend. Using a budget will help you to monitor actual revenue and expenses to keep you on track. Be sure to revisit your budget regularly and keep prior versions so that you can see how your actual revenue and expenses have changed over time. Use our workbook for your near-term budget. Use technology and automation to save time. Productivity software and online systems such as Microsoft Office, Apache OpenOffice, FreshBooks, QuickBooks, and Gusto can help with operations, bookkeeping and payroll, and reducing the time needed. One quick example, I used to have a provider that did everything by paper and pen. Once she switched over to a childcare management system and QuickBooks, it made things so much easier and a lot faster. And she was able to fully delegate some of that and other options, other tasks to her childcare management system. If you want to learn more about those things, I recommend you check out our Utilizing Technology small study group. You can also research credit cards with lower rates or low interest-free balance transfers. Finding a credit card with a lower rate or a balance transfer can reduce interest costs. Be careful with them, as they have promotions typically, and they have usually some different stipulations as to what you can and can't transfer. So be mindful of that as well. Also, balance transfers, just side note, do not count for any points, by the way, with those credit cards, just so you know, usually. Review your bills to identify subscriptions to cancel. This is one of the most common ways, and actually most effective ways, we've seen to reduce some businesses' expenses. So many people, so many business owners have recurring subscriptions that they're just not using. Small monthly or other recurring costs can really add up quickly. It might seem like not a big deal to pay $9.99 a month for Netflix without ads, right? But if no one's using Netflix in the business, then why do we have it, right? Check your bank accounts and credit cards for recurring transactions that you can live without. Another thing to check is if you remember that you tried like a free subscription and forgot about it, and the 7-day trial ended and now you're paying, sometimes that happens and people don't even realize it. So again, be sure you review your bills to look for anything that is a subscription that you can cancel. Look for shared services alliances in your area. A shared service alliance for childcare businesses can decrease costs by enabling collaboration, sharing resources, and accessing better rates on supplies and services. They offer centralized functions like payroll processing and professional development and reducing administrative burden and expenses while allowing you to allocate more resources to enhance childcare quality. Step 2, allocate your surplus to debt repayment. Set a goal for minimum monthly payments and stick to it. Calculate the most you can afford to pay toward your total debt each month. To get started, consider building a monthly budget and 6-month cash flow to understand your financials clearly. Determine what amount you can dedicate to repayment of your debts each month, including the total minimum payments owed and as much extra as possible. Remember, paying debt down swiftly can help you keep as much money as possible in your pocket. One way to identify how to do this in a way that will be effective is to identify some of the lowest amounts that need to be paid off, and then paying those off first. That way, whatever money you were allocating to that lowest cost minimum payment and lowest debt amount can be rolled into the next creditor that you need to pay. So to do this, you want to identify all the relevant information about your debts, including outstanding balances, interest rates, and minimum payments. You want to organize this information on a list or a spreadsheet for easy reference. Evaluate the total balance. Assess the total balance of each debt relative to your financial situation. Prioritize debts with lower total balances as they may be easier to pay off quickly. Consider minimum payments. Evaluate the minimum payments required for each debt. Focus on the debts with higher minimum monthly payments as they may significantly impact your monthly budget. And evaluate interest rates. Identify the debts with the highest interest rates as they accrue more interest over time, meaning you lose more money the longer you hold these balances. Debts with the highest interest rates, typically associated with credit cards or high interest loans, should be prioritized for repayment to save the most money in the long run. Revisit your list and prioritize debts for repayment regularly. Step 4, determine how much you need to reduce. Now that you've calculated your current debt to asset ratio, it's time to figure out how much debt you need to eliminate to reach your target ratio. Follow these steps to set your goal and determine the necessary debt reduction. Set a target debt to asset ratio. Decide on a realistic and healthy target ratio for your business. A commonly recommended goal is 30%. This ratio balances manageable debt levels with sufficient leverage for business operations and growth. Determine target debt level. Once you've chosen your target debt to asset ratio, calculate your target level of debt by multiplying this ratio by your total assets. Target debt to asset ratio times total assets equals target debt level. So for example, if your total assets are $100,000 and your target ratio is 30%, then 30% times $100,000 is $30,000. Calculate debt reduction needed. Next, figure out how much debt you need to get rid of to reach your goal. That's your total current debt minus target debt level equals the amount of debt to pay off. So for example, if your current debt is $50,000 and your target debt level is $30,000, then $50,000 minus $30,000 equals $20,000. Step 5, create your repayment plan. Now that you've assessed your debt to asset ratio, set your debt reduction goal, and prioritize your debts for repayment, it's time to create your plan. Here's an example. Meet Aisha, the owner of a small childcare business called Little Learners. Aisha is determined to improve her business's financial stability by reducing her debt to asset ratio from 54.4% to 30%. Here's how she achieves her goal step by step. Step 1, calculate current debt to asset ratio. Aisha calculates her current debt to asset ratio as 54.4% with $125,000 in assets and $68,000 in liabilities. Step 2, set debt reduction goal. Her goal is to reduce her debt to asset ratio to 30%, which requires bringing her liabilities down to $37,500. Step 3, determine monthly repayment debt capacity. Aisha can dedicate $1,200 per month to debt repayment, which includes her cash flow surplus of $315 plus what she currently pays as minimum payments on her debts, which is $885. Next, prioritize and pay off debts. Aisha examines her debts and decides to prioritize them based on their interest rates and balances to optimize her repayment plan. So here are some examples. Her credit card debt has a balance of $3,000. It has an interest rate of 21.5%. The monthly payment is $365, which includes $315 of cash flow surplus and $50 a month minimum payment. Time to pay off, about 6 months, calculated as $3,000 divided by $365 equals about 8.2 months, but rounding down for simplicity and potential additional payments. Her car loan has a balance of $15,000, but the interest rate is much lower at 3%. Her monthly payment is $635, which includes $365 redirected from credit card after its payoff and the $270, which is the original minimum. The time to pay off, about 12 months, calculated as $15,000 divided by $635 a month. That equals about 23.6 months, but simplified to 12 months for the example. Apply full payment capacity to the mortgage. Once Aisha has paid off her smaller high-interest debts, she redirects her full repayment capacity towards her remaining debt. Her mortgage, the balance is $50,000 initially, reduced to $37,500 to meet the target debt level. Her interest rate is 5%. Monthly payment, $1,200, which is the total monthly budget after paying off other debts. Time to reduce to $37,500 is 10.4 months, calculated as needed reduction divided by monthly payment. The reduction needed was $50,000 minus $37,500 equals $12,500. The monthly reduction, $1,200. Time required is $12,500 divided by $1,200 equals about 10.4 months. Step 5, achieve debt to asset ratio. By consistently applying her repayment strategy, Aisha effectively reduces her debt to asset ratio from 54.4% to 30% in approximately 28.4 months. Total time calculation, 6 months for the credit card, 12 months for the car loan, and 10.4 months to adjust mortgage to $37,500. So the total is 6 plus 12 plus 10.4 is 28.4 months. By the way, meanwhile, she's always paying each month the minimum balance, the minimum payment due for each of these debts. Here are a couple of tips and tricks. If you pay more than the minimum, you can avoid the trap of paying only the minimum amount due, as this will, if you continue to pay the minimum amount due, it'll prolong your debt repayment journey. If you allocate additional funds to your debt to accelerate repayment and minimize interest costs, you'll be able to repay it faster and with less interest. Maintain consistent payments. Keep making consistent payments even as minimum payments decrease or debts are paid off. Continue allocating the same total amount toward debt repayment. So don't get fooled by the minimum payment dropping. Okay, so continue to pay based on your plan, so that way you can pay debts off faster. Stay disciplined. This is probably one of the hardest things to do. Maintain focus on your goals and stay disciplined in your financial habits. Regularly monitor your progress and be prepared to adjust your plan as needed. One way to do this is to decide early how you want to celebrate. Now, celebrating doesn't mean that you pay your thing off, or I mean, you pay a debt on time, so you take yourself out for dinner on the same credit card. That's not what I mean. When I talk about celebration, it might be checking something off or giving yourself a sticker. It could also be just it could be that you watch your favorite show or something, right? But do something to celebrate is doing something to celebrate is something that can help us stay disciplined, especially if we're the only one running the race. Set up automatic payments. You can automate your payments to ensure they are made on time each month. So that way it's out of sight, out of mind. There are some people that like to pay everything manually, and that's okay too. But if you set up automatic payments, then it allows you to really not have to think too hard about paying it, and it also ensures you don't make the human error of missing a payment. Use reminders. Utilize calendar alerts, phone reminders, or scheduling apps to remind you when the balances are due. So this is great for if you are a manual payer. You can use these calendar alerts to remind you, just give you just like a reminder to show up to this training, right? So you can do that as well in your calendar. If you need help with that, you can set up a one-on-one coaching session. We can walk you through how to do that utilizing technology. You can set up the notifications that can alert you when bills are due, but also, which is a common challenge, if an account is low, right? So sometimes providers have a lot on their plate and cash flow is so tight that sometimes the automatic payments, they may draw on a day that money is too low in the account. So one great practice would be to set up in your mobile app, on your banking app, an alert if a balance goes below a certain amount. So let's say you need $5,000 a month to cover all of your bills that come out automatically. Well, you can set it so that way if your minimum balance, or not minimum balance, if your balance goes below $8,000, for example, or $9,000, then you are sent an email or a notification or an alert or all three. And that can help you recognize, oh, shoot, I need to draw from my personal account and put it into the business before a certain date, or maybe you increase the sales of something, right? Or maybe it's time to really call back some of those parents that owe you some money, right? Next, you can stagger payments. If you are paid bi-weekly, you could consider staggering payments across paychecks. Use extra income to accelerate debt repayment or bolster your savings. Now, even with a solid plan, it's important to recognize when debt is becoming unmanageable. Let's discuss some warning signs to watch out for. Now that you understand how to assess and manage your business debt, you're well equipped to maintain and enhance the financial health of your business. With consistent application of these steps, you'll strengthen your business's financial base. If you find that your debt levels are challenging to manage, or if the situation seems severe, don't hesitate to proceed to part 3 of our guide, Navigating High Debt, where we offer specialized strategies for more complex financial challenges. And remember, taking proactive steps now can secure your business's future and lead to sustainable growth. Let's talk about how to recover from high debt. Now, it's common for businesses to experience financial strain and take on debt to continue operations from time to time, even when you need to work on reducing your debt after these periods. The key is to ensure you remain in control of your debt rather than letting it control you. Is your debt to asset ratio above 30%? Are you having difficulty regularly making monthly payments? Are your balances growing despite making payments? Or are you relying heavily on credit cards for everyday expenses? Another good question is, are your payments toward consumer debt above 50% of your income? If you owe half or more of what you earn each month to consumer debt, a significant portion of your earnings is tied up in high interest debt repayment, which can accumulate very quickly. Are you receiving calls from creditors or have accounts in collections, or is your credit damaged? These are clear signs your debt situation is critical. Do you have maxed out credit cards, or are you having a hard time saving enough money to do anything about reducing your debt? If any of these questions sound familiar, don't worry. There are steps that you can take to get yourself feeling more in control. What can I do if I can't get ahead financially, no matter what I try? Some of the most common approaches to addressing high levels of debt are creditor negotiation. This involves talking directly with creditors to seek more favorable terms. Debt settlement, which involves negotiating with creditors to pay a lump sum that is less than the total amount owed. Debt management programs, which are often offered by nonprofit organizations. These programs typically consolidate your payments into a single monthly payment to the program, which then pays your creditors. While they can lower your monthly payments, they often extend the repayment period, making them a multi-year commitment. Ensure the organization is reputable. Nonprofits are a good option due to their lower fees, client-focused services, and increased regulatory oversight. You also have debt consolidation, which combines multiple debts into a single monthly payment. This can be done through personal loans, balance transfer of credit cards, or home equity loans, home equity lines of credit. It's important to understand the terms, as options like home equity lines of credit use your home as collateral. If you need more help seeking professional support, could actually really make a significant difference. And here are some options that you can consider. There are debt counselors, which give personalized guidance and also they're also often from nonprofit organizations. They help you assess your financial situation and create realistic debt repayment plans. Nonprofit organizations specialize in debt management and financial education without profit motives. Often they offer structured programs to manage and reduce debt, provide financial education and resources, and assist with debt consolidation. Financial advisors are certified professionals who offer comprehensive financial planning and debt management advice. Look for individuals with relevant certifications such as a CFP, experience in debt management, and positive client reviews. Now, typically, financial advisors do charge higher rates for their services than debt counselors or nonprofit organizations, so it's important to understand their fee structure upfront to ensure it aligns with your financial situation. Credit unions are another good option. They are member-owned financial cooperatives that often offer lower interest rates on loans and financial counseling services. Regardless of who you choose for support, it's important to remember that you still have choices and how you feel matters. Here are some tips to guide you in selecting the best option. Be sure you research and compare by looking into multiple options, compare fees and reputations. Check credentials by ensuring that the professionals you're considering are certified and accredited. Read reviews, ask questions. Don't hesitate to ask these potential providers about their approach, what they offer, and any costs. And trust your instincts. Choose a support provider that you feel comfortable with. And by selecting the right support professional, you can gain the guidance that you need and the resources needed to take control of your debt. In very extreme situations, professionals may recommend that you consider filing for bankruptcy. The ability to continue operating your childcare business after declaring bankruptcy depends on the type of bankruptcy filed and the specific circumstances of your business. Here's a detailed look at how different types of bankruptcy may impact the operation of a childcare business. Chapter 11 bankruptcy allows businesses to recognize their debts or reorganize their debts and continue operations. It's designed for businesses that have the potential for future profitability but need time to restructure their finances. Under Chapter 11, your business can continue to operate under a court-approved reorganization plan. However, Chapter 11 can be complex and costly, necessitating detailed financial planning and legal assistance. Chapter 13 involves a repayment plan for individuals with a regular income, allowing them to keep their assets while paying off debts over time. It's typically used by sole proprietors who can continue to operate their business while repaying debts according to a court-approved plan. Chapter 13 allows individuals to manage both personal and business debts under a single repayment plan. Chapter 7 involves the liquidation of assets to pay off debts. It is generally used by individuals and businesses that cannot realistically pay off their debts. Instead, business assets are liquidated to pay off creditors. In most cases, filing for Chapter 7 means businesses will cease operations, as the liquidation process often includes selling the business's physical assets such as equipment, property, and supplies. As you can see, there are many ways to tackle high levels of debt. However, regardless of which option you choose, it's important to view these steps as the beginning of a recovery phase rather than a negative ending. As we wrap up our discussion on managing debt for childcare businesses, let's review the key takeaways. Debt can be a useful tool for growth, but it's crucial to understand its full cost. Regularly assessing your debt to asset ratio helps you maintain a clear picture. Creating and sticking to a debt repayment plan is essential. Being vigilant about warning signs that your debt might be becoming unmanageable. And if you're feeling overwhelmed, don't hesitate to seek professional help. Most importantly, remember that you're in control of your financial future. With the right strategies and support, you can manage your debt effectively and build a strong, financially stable childcare business. Okay, so let's open it up now for questions. I prefer that you guys put your questions in the chat. I'll go ahead and take a look in the chat for any questions. If you haven't put information in yet, I see that Sharika Moore is having difficulty. Okay, there we go. There's hers. Great. While you're putting any questions or comments in the chat, I also want to take a moment to let you know about our 2 brand new small study group topics. First, we have maximizing credits to strengthen your childcare business. This in 4 sessions, you get to learn how to identify quality for Georgia and federal tax credits that can reduce costs and support staff and strengthen your bottom line. And then also, I really highly recommend this because there are some tax credits that are newer with the One Big Beautiful Bill. So please take advantage of that small study group. Next, there's revenue stacking in Georgia, where you can build a more sustainable business by combining Georgia's major funding opportunities. And in this, we get to explore how quality-related payments, caps, subsidies, and Georgia's pre-K enrollment and other state supports work together to increase your revenue and stability. So whether you're brand new or you've been using for years, you'll still walk away with strategies to strengthen your financial foundation. We're registering people for both of these right now. You can get a copy of the worksheets. So I can double check. I'll write that down, copy of worksheets emailed to you. But what worksheets specifically? Are you talking about the guide? You can just put the answers in the chat. Yeah, okay, got it. So I'll double check on that. Thank you, Miss Stacy. Okay, and also, just like in all of our study groups, you'll earn both Georgia approved training hours and $125 stipend when you complete each of those small study groups. All right, so this is it in Spanish. Hopefully Sol was describing that. You can scan your QR code or this QR code to access the website. We can also use this for the maximizing savings, tax savings. So these are our next webinars. So it'll be just like this one. Scan this QR code to register for this. So maximizing tax savings, proactive year-end planning. That's a great one. It helps you identify the things that you may need to see how your financial position is in the end of this tax year. An annual business plan is Friday, December 12th. So that is also coming up very soon. The last one that I'd mentioned, maximizing tax savings, is Tuesday. So that's coming up very shortly here, December 2nd at 6 p.m. And then the annual business plan is Friday, December 12th at 11:30 a.m. And lastly, little plug here, is the tax education coaching. So this is a really great program. You can review your 2024 or 2025 tax returns to help you identify opportunities to protect you in the risk of, not just protect you, but to help you mitigate risk in the event of an IRS audit, but also see if you can find tax savings. If you get one of these tax education sessions and you find out that you're paying too much in taxes, I'll answer that question, Ms. Stacy. So again, real quick, with a tax education, if you learn something about your tax return that you can improve, those savings will stay with you every year you continue to stay in business, right? Now, when it comes to the stipend for training, it's any of our small study groups. Now, the small study groups are, sorry, the small study groups you can find here. Hang on one second. Here. So if you go onto the Thriving Childcare Business Academy website, you should see a link on there. You can go ahead and scan that with your phone. If you're using your phone right now, you can take a screenshot of this and then go into your photos and then hold your finger on the square, and it should bring up a link. Once you get into there, you should see some options for signing up for small study group trainings. And again, they're 4 sessions long, about 45 minutes to an hour each session, and you get to interact with other providers like you are here on this call, and also have some homework to do. Once you complete those, you get that $125 stipend. Okay, I am not seeing any other questions in the chat. I do want to confirm that everyone puts their PDS number in. Does anyone have any key takeaways for managing debt? Would love to hear your feedback. We definitely want to make sure that we're providing accurate and helpful information. So please go ahead and put in your chat your biggest takeaway from today's conversation. This will, again, it'll help. I know that we're a little over time here, but one thing I do want to make sure that we say is that if there was anything on here whether we're talking about debt to income ratio, or how can we use debt to really grow the business, and figuring that piece out, I strongly recommend you get one-on-one coaching, because you scan this QR code and you can sign up for one-on-one coaching as well. The one-on-one coaching sessions are where we can talk personally about your situation specifically, and we can go through the eaches of what you need to do, first, like step 1, 2, 3, and 4, and we can kind of hold your hand through the process of getting you to the goals that you set. If one of your goals is to set goals for the year and for your business, we can walk you through that too. So I strongly recommend, I can't urge you enough to sign up for the one-on-one coachings using this QR code. So that's 3 things that you can do just from tonight. Okay. Oh, also, if you want, you can come off of mute and you can give me your feedback that way too, if you're having trouble typing things into the chat. I'd really love to have your feedback as to what was your biggest takeaway from today's conversation. Miss Kathy, you still there? Also, I don't have Rainer Home. Who's Rainer Home? Because I don't think I have your. There you go. Hi, Miss Stacy. What was your biggest takeaway from today, Miss Stacy?
I'm gonna say maybe the one that said when you say even if your payment drops, to continue making the same amount of payment, to not drop the payment, to make sure that we can pay off the debt faster.
Mm-hmm.
Absolutely. I wish I could only do that one-on-one, because I don't know what I qualify for. I'm not licensed, so I just watch my grandchildren.
Okay.
And I might get like $200 a week, but $200 a week, I still got to pay taxes on that.
Huh. I mean, yes, you do. So you're receiving $200 a week? Okay.
Mm-hmm.
Okay.
And,
Right.
because it's
Right.
before and after.
I would definitely want you to get into a one-on-one coaching session, and especially one of our tax coaches, whether it's myself or Miss Jen or Coach Carlos. We will walk you through some of those as well. But yeah, definitely.
Yeah, I'm just having more take out of my payroll from work, so I won't have to pay. Hopefully, I won't have to owe the government next year.
Oh, I see what you're saying. Yeah. Mm-hmm.
So,
So getting onto the website there, like I said, if you get onto that the business academy website, you'll be able to sign up for some one-on-one coaching with us.
I see it. I appreciate it.
Mm-hmm. Awesome. Great. Well, thank you all so much. Oh, thank you for adding that in. Setting up notifications, reminders will be helpful. Thank you all so much for your time and your input. I hope everyone has a great night. Got it. Yes, I see you. Rainer Home, which is Miss Catherine. I see you. Got it. And we got your PDS number. Thank you very much. And Miss Kathy. Yep, we see yours as well. Great. Thank you. Thank you so much, Miss Sharika. Have a great night, everyone.
All right. Thank you. Good night.
Yep, bye. Enjoy your Thanksgiving. Thank you.
Thank you. I learned a lot.
Mhm. Awesome. All right, thanks. Bye. All right, bye. Oh.